Alright, now I'm actually running again. Yeah. Alright, so basically what I'm doing today is I'm showing you some stock that I found that was particularly interesting. So we have here Dan Gilbert. He is an American billionaire who lives really close to where I live. And his net worth just shot up. And the reason for this is because the company just IPO'd a few months back. And so he went from, private company to a public company and made a very large amount of money. The thing is I ran some very basic numbers on this company using the growth rate indicated by, if I go down to analysis here, we have they've changed it, but it was at 26%. But, this is a little bit, you're going to have to realize that this is not going to be accurate, especially right now, because they only have been around for about 6 months at this point. So, actually not even 6 months, so since August, which is 8, and we've only had, so like 4 months it's been public. So, this number is kind of variable, but if you plug in like 7% at a really not so great growth number, that'd be alright. I have a really average, terminal value, so it's like what your P ratio is, what you can get for the company when you sell it. And I said I want a 20% discount rate, which is like the rate that you're expecting to get. So essentially what you're calculating is if you want 20%, what would be a break-even amount. It's like skewing it, essentially, if you think of it as a graph. It's like moving your break-even upwards. So like whatever your zero normally would be, it's moving everything down. So that way you can sort of approximate, because technically an intrinsic value is slightly subjective. So if I want to get a certain return on something, my ideal price for something will be different if your return's different than mine is. So my ideal return would be 20% down to 30 years. Like that's 270 times whatever your initial investment is. So if I put, $1,000, that's $237,000 over about 30 years. But if I went over here to like Desmos, for instance, so of course like after 60 years that would be quite a bit of money. But I mean, I suppose you'd have to do a summation on this. So that was, yeah, it seems about right. 300 million. Yeah, that's close. Yeah, but 20% seems like a really, really solid amount, because you would become a billionaire probably by the time you're like 70 or 80. Not that, you're going to get perfectly, but you can try, shoot for the best. I, of course, think you should try shooting to be a trillionaire, because, it's not going to be long until trillionaires are the emerging new superclass of wealth, because right now in this country we have 20 million millionaires. We have around 600 some billionaires, and trillionaires will emerge very shortly. I mean, you can just look at Jeff Bezos' wealth, which is 186. So if I just go back to Desmos real quick here. Yeah, 25 years. That's like a really tiny growth rate, but let's be honest, he's probably going to have a better growth rate than 0.7. So let's put it at I don't know, 9%, maybe more. 20 years. So by the 2040s, he would be a trillionaire, even if he just took all his money out and put it into an index fund somehow. It's a lot of money to put into an index fund. He'd probably make his own investment company, kind of like how Bill Gates did it. I don't know, but I don't think he's going to pull out of, he's not going to stop doing Amazon, obviously, but he is cashing out $10 billion chunks every year, because he knows that Amazon is clearly just overvalued. So if I go to Yahoo Finance, if I go to Amazon, its PE ratio is 93, which is extremely high. It's not as high as it used to be. It used to be a lot higher, but its PE ratio is still quite high. It's PE ratios, right? Your profits to earnings ratios, how much money, if you think of a company like a brick, and you would want that brick to just spit out a certain amount of cash, and you're oh, I'm going to sell this. Well, you wouldn't sell it for 1 unit of spit out, right? You'd sell it for I don't know, an upfront value of a certain amount of spit out, because you need that money now. It's essentially borrowing against a stock, saying look, I'll sell these stocks later on, but right now I'll just use them as I'll borrow against them, if you will. But instead of borrowing, you're just flat out selling the asset. But it's because if you look at it, most companies only have life expectancy around 40 years. I think most companies, once they're into the S&P 500, they're already past half the life expectancy. Companies don't last for more than about 40 years, so it's like a PE ratio this high is like kind of a little crazy. Chances Amazon's around in a century, probably not likely. I mean, there's very few companies that have lasted like more than 100 years, like Ford, probably GM. Well, GM's not been around for 100 years, have they? 1908? Oh yeah, 1908. Okay. So yeah, they've been around for a century. Companies that have been around for a century. List of oldest companies in the United States. Interesting. So these have all been around for a very long while. Very stable companies. Interesting. I have to look into this later on. Alright, so the companies that seem to be like, older than a century are all on this list except for Lockheed Martin and IBM. Actually, no, IBM was founded in 1911, so actually it is older than a century. I think every single one of these is older than a century. Maybe, no, I'm just going to go on a limb and say they all are because I looked at most of them, and of course most by name are pretty obvious. Like, I was a little surprised to learn how old Colgate was. But that's one of the points is like, okay, of course, the companies here, they some of the very few that have like are really big companies that stay alive. U.S. Steel is a shell of its former self. It's the first billion-dollar company. Now only holds 8% of the market. It really hasn't been anything of substantial size since like 1911. So like it hit its peak like a few years after its creation. Big companies used to have lifespans of 61 years, and now it's down to 18 years. Ooh, this is interesting, but I'm gonna have to read other articles later on. Alright, so now I've gone through my little spiel of what would be what this sort of does. I mean, I tried to explain the fact that intrinsic value is subjective, right? And then after that, I went ahead and pointed out like why my particular choice of a discount rate of 20% was a good idea. And then I went on a tangent about a few different things about companies that are interesting. And so the main thing that I suppose is adjustable is right here. I could adjust this and change it to like 24% or a bigger terminal value, and that would give me a higher intrinsic value to what I would like it to be. But 12% is a very modest amount. I haven't included any debt because I really haven't looked into the company yet that much. I mean, I do understand it's a mortgage-like broker. It makes the mortgage, it gets the client, signs it off, and then it sells it to an investment bank. And the investment banks are the ones actually taking on the risk. So in terms of this like company, like they're holding Quicken Loans, and Quicken Loans is the largest mortgage lender in the entire country. So that's pretty impressive. So I'm going to look into them a bit more. But overall, yeah, I think it's a great stock. I mean, even if you want to make a 20% return according to their current growth rates, and I don't see why this they don't have room to grow really. They're a very young organization, so got lots of life left in them. And I gotta say, they're building a gigantic building in Detroit. Like, they're bringing all this industry back to Detroit. So they have the right mindset definitely the right mindset. Well, on top of the fact that they don't take on any of the risk themselves, good idea. But yeah, 83 billion for was around 40 billion dollars. It's like literally half off basically, even if you want to make a 20% profit. So you got a very large margin of safety for just going off of this. Now, unfortunately, I can't look into really much else because they haven't been around long enough, frankly. I have to wait around to see their other financial statements. It'd be really nice to have some statistics or on the financial statistics. The enterprise value would be nice. It'd be nice to know the trailing PE ratio of 481 and a forward PE ratio of 10. Now that's a mighty large difference. Normally you average the two to get a PE ratio, so this would be gigantic, wouldn't it? Well, it'd be like 200 when I was criticizing Amazon for having 93. Now here I am promoting this guy. I don't think, because from what I understand, right, the company's like 40 billion, and yet their free cash flow is 5, so that seems to be like a multiple of about like what, 20? Not 20, sorry. Yeah. 8. That's a multiple of 8, not 400, and I don't know where they're getting that number from. Maybe it's because when it originally IPO'd or something. I don't know how they're calculating it, but it doesn't seem quite right to me. Maybe they don't calculate it based on cash flow. They calculate it based on like net profit of the company. That's a good question. I don't know how you calculate like that, if they use cash flow or if they use like gross profit. I should find that out. Well, I haven't invested any of my money yet, so I think I'll have to start doing that. I think I'll invest like, $100 a month. That seems like a good amount. Anyways, that's all I have for you today. Looking at a company, just trying to understand how much is this company actually worth based on how much I want to make from it, and then seeing if it's at a good deal. So essentially you're like, okay, my bare minimum is I need to make money, and I need to make this much money, and then I want to see, based on that, like, how much would it be worth? And then I don't buy it for like that value. You want to buy it for less than that in case you've done something wrong, which you probably did. So that's like, what if you got the growth rate wrong? This is a pretty big margin of error. So see you later.